In this video, I'm going to discuss and provide updates on my current top 5 favorite monthly paying dividend stocks in ETFs. The investments on this list are a combination of income holdings, which are higher yielding holdings that don't offer much growth, and dividend growth investments, which have lower yields but provide longer term dividend increases. These investments are in no particular order, and depending on whether you're targeting more growth or income, you'll want to weigh the pros and cons of each investment and decide which ones are worth considering for you. So with that being said, let's get right into it. The first stock is Main Street Capital, ticker MAIN. They're a business development company that provides one-stop capital solutions, which includes private debt and equity capital to lower middle market companies and debt capital to middle market companies. Main Street's portfolio investments are typically made to support management buyouts, recapitalizations, growth financing, refinancing, and the acquisition of companies that operate in diverse sectors. Despite offering the lowest yield on this list, the performance of Main Street Capital has been excellent. It's rare for a BDC to offer really good growth, as most companies in this sector have had flat share prices with higher yields. But this BDC stands out for its excellent long-term growth. They've never had a dividend cut in their history and have since grown their dividend almost every year since their IPO in 2008. You'll also notice they pay a good amount of special dividends at times, represented by green on the chart. The key to Main Street's success is them doing well at picking equity investments. Most BDCs like Blue Owl Capital hold almost all first lien debt and then a tiny amount of equity. Main Street holds a lot more equity investments, which explains the lower yield, but the share price growth has been excellent for them. There's another really successful BDC that holds more equity like Main Street, which is Capital Southwest, although they don't pay monthly dividends. Up to this point, Main's continued to post record NAV growth, which is the most important metric for a BDC. The only downside to investing in this stock is that it's very often overvalued. The best time to buy Main Street is when there's a sizable drawback in share price. Right now, Main Street's currently trading at its all-time high, so I haven't bought any more additional shares for a while, with the exception of reinvesting my dividends. But when it comes to monthly dividend stocks that offer good long-term growth and a higher yield than average, Main Street Capital is pretty hard to beat. The next investment on this list is the NEOS S&P 500 High Income ETF, ticker symbol SPYI. This ETF describes itself as a fund that seeks high monthly income in a tax-efficient manner with the potential for upside appreciation in rising markets. The fund invests directly and through derivatives in stocks of companies operating across diversified sectors and uses derivatives such as options to create its portfolio. This ETF seeks to generate high income from the premiums earned from SPY call options as well as derivatives received from the fund's equity holdings. As of the making of this video, SPYI currently yields a little over 12%. Despite this ETF still being a newer investment, I've been really pleased with the results up to this point. There's a couple things that make this covered call ETF stand out from others. It's an actively managed fund, which you would think would come with a much higher expense ratio than the alternatives, but that isn't the case. SPYI utilizes a call option strategy that can include both sold and purchased SPX index options, which can provide the opportunity for better upside capture in rising equity markets. If we compare this ETF with XYLD, which is another S&P 500 covered call fund, we can see SPYI does a better job when it comes to appreciation in rising markets. Plus, it offers a much higher yield than XYLD, so in my opinion, going with SPYI is a no-brainer as opposed to XYLD. Finally, one more unique aspect of this ETF is that, because it's actively managed, it seeks to take advantage of tax loss harvesting opportunities. In addition to utilizing SPX index options classified as 1256 contracts, these are subject to lower 60-40% tax rates. So there can be tax-saving opportunities with this ETF that you wouldn't see with others, which is another big plus. It has offered a little bit of growth, but it's mostly an income holding unlike Main Street. The vast majority of the growth that you'd experience from this holding would come from reinvesting the dividends. So with a yield of over 12%, good diversification, and potential tax savings, SPYI is currently one of my favorites and is actually my current favorite income ETF. This next investment is one that I'm going to skip right over because I just made a video about them and I've gotten the message that people are probably getting tired of hearing about them. But Realty Income would definitely be included on this list as a dependable dividend grower that's now yielding over 6%, which is excellent. Moving right along, the next investment is the InfraCap Preferred Stock ETF, ticker PFFA. According to its website, the fund seeks current income and secondarily capital appreciation through a portfolio of preferred securities issued by U.S. companies with market capitalizations of over $100 US. According to its fact sheet, this ETF has 3 distinct features, which are a focus on income, active management, and enhanced exposure through using a modest amount of leverage to help enhance portfolio beta and current income. PFFA is a relatively newer preferred stock ETF, having launched in 2018 and about a year and a half before the pandemic and subsequent interest rate hikes. Preferreds were an area that I wasn't invested in until recently, but from an income perspective, these kinds of holdings are pretty ideal. Preferred stocks represent ownership of a company just like common stocks, but they're a little different in a couple key areas. They're more like bonds in that they pay a set amount of dividends each quarter and there isn't too much share price movement. But the dividend amounts are much higher than average with preferred stocks, and preferred shares are safer than their common stock counterparts. Before a stock can issue dividends for their common shares, they first have to pay dividends on their preferred shares first. The InfraCap fund, though, is able to pay dividends monthly as opposed to quarterly, and this ETF also uses some leverage to boost its dividend. This can make this a riskier holding than other preferred ETFs that exist, which is something to keep in mind if you're more risk-averse. Preferred stocks as a whole are still down because they're more interest rate sensitive investments. Again, PFFA isn't a holding that you should expect to see good amounts of growth with, but preferred stocks, especially preferred ETFs, can be really good considerations for retirees or people who just love a high monthly dividend. It currently offers a yield of a little under 10%, and it's pretty decently diversified across different sectors. This last investment we'll take a look at is JEPQ, which is the JP Morgan Nasdaq Equity Premium Income ETF. The goal of this ETF is to deliver monthly distributable income and Nasdaq 100 exposure with less volatility. It implements written out-of-the-money Nasdaq 100 index call options that seek to generate distributable monthly income. With a yield of roughly 10% and share price growth of over 11% this year, JEPQ is a holding that's taken advantage of the tech and AI boom we've been experiencing. Its top holdings are pretty similar to those of QQQ, which is the Invesco ETF. You'll notice it has Microsoft, Apple, Nvidia, Amazon, and basically all the big tech names. It does deviate from QQQ in some ways, such as holding some equity-linked notes and some exposure to other underrepresented sectors of QQQ. Apparently JEPQ has held index funds at times, although it looks like as of the making of this video, they currently don't. And despite being actively managed, JEPQ charges a much lower expense ratio than what's typical of an actively managed ETF. The only concern I have about this holding is how it'll fare during a sizable downturn. There's certainly been a lot of hype surrounding this ETF because it's done so extremely well, but that's mostly because of the tech boom. If there is a bubble, we don't know how severe this ETF's share price and dividend distributions are going to be impacted. One of the biggest features this ETF touts is being less volatile, but we've yet to see how well it actually does when put to a serious test. If we do experience some kind of catastrophic bubble burst in tech, then I wouldn't rule out possibly selling my shares of this ETF. And those are my top favorite high-yielding monthly dividend investments as of the making of this video. My picks include a REIT, a BDC, a preferred ETF, a broad covered call ETF, and a hybrid Nasdaq 100 covered call ETF. If you're interested in any of these holdings, I would still suggest conducting your own research to see if it's a right fit for your portfolio. Because as I mentioned in the beginning, there's a mixture of both growth and high income here, so depending on what you're going for in your portfolio, you might want to consider some and avoid others. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.